Hi, Nathan from Buyers Club here. With the ongoing conflict in Iran, we've already seen real impacts in the global economy, particularly in energy markets. And it's fair to ask, should property investors be concerned about potential knock-on effects in the Australian property market? The short answer is that it's worth paying attention to, but likely shouldn't change your investment strategy. To illustrate the scale of the situation here, though, a couple of weeks ago, the International Energy Agency described the conflict in Iran as the largest supply disruption in the history of the global oil market. Around 20% of global oil supply has been disrupted, with shipping through the Strait of Hormuz effectively stalled. And despite this happening on the other side of the world, we're already feeling the effects here in Australia, especially in fuel prices. This chart from the ACCC shows petrol prices in Sydney recently, and you can see just how sudden the impact has been. As recently as early February, just prior to this conflict, fuel prices were down at around $1.60 per litre, but since then have surged towards $2.20 per litre. And this is where it starts to matter for the property market as well. Rising fuel and energy prices from this conflict have contributed to higher inflation expectations, which is one of the key factors behind the RBA's decision to raise interest rates for the second time this year on the 17th of March. In their official statement concerning this decision, the RBA did point to lingering inflationary pressure across the latter half of 2025, but also explicitly mentioned the conflict in the Middle East as grounds for adopting a more cautious posture towards inflation in the near future. So inflation was already there on some level, but this situation is adding to that pressure. And notably, this wasn't a unanimous decision, unlike the first rate hike in February. Board members were actually split 5-4, which just reflects the uncertainty, even within the RBA itself, about how persistent these new inflation pressures might be. But we have seen similar dynamics at play before with other conflicts, and we've seen how interest rates have responded to similar situations in the past. In 2022, we saw a very similar situation upon the start of the Russia Ukraine war. Russia is one of the world's largest oil exporters, and the conflict at that time created massive inflationary pressure through very similar oil market knock on effects. You can see here the huge spikes across a range of commodity prices, including energy, metals, even food prices at the start of that conflict spiked massively back in 2022. And just prior to the start of that war, indicators of inflation had already been creeping up throughout 2021 in the preceding year. So, again, a bit of a similar situation to what we can now see developing, where you already had some lingering inflation concerns before an overseas conflict created a further sudden shock to global supply. And when we look at what happened to Australian property in 2022 following these events, it was significant. The RBA responded with one of the fastest rate hiking cycles that we've ever had. And in just over a year, the cash rate went from an incredibly low 0.1% to over 4%. And unsurprisingly, we saw a large decline in house price growth. You can see that fall on the chart here on the right, occurring alongside each of those red dots, which indicate that run of consecutive rate hikes. And you can see just how badly the property market reacted over that period here. We saw price falls across many major markets, and even regional markets weren't immune to this, as you can see on the right here. And given the similarities between Russia, Ukraine in 2022 and Iran today, it's fair to ask if history is about to repeat itself. Are we about to see another major rate hiking cycle and another decline in property growth? In this case, I don't think so, because there are a few really important differences at play. In 2022, the Russia Ukraine shock hit while the global economy was still dealing with major COVID distortions. Supply chains were already strained and inflation pressures were ubiquitous at that time. And you can clearly see that reality given how central banks around the world responded to the situation. It wasn't only the RBA that was rapidly increasing interest rates, but it was happening everywhere at once. And this chart shows central bank interest rates from around the world over much of 2022. And every central bank here, besides Japan, underwent a major rate hiking cycle in response to that development. Fast forward to today, though, and most central banks are still cutting rates, not raising them. And so far, the RBA is actually unique in opting to raise interest rates this year. So in 2022, Australian property markets really felt the impact of having just come out of that ultra low interest rate period, back when the cash rate was at its lowest level ever, down at 0.1%. Then interest rates moving so suddenly from 0.1% to over 4% had a very sudden impact upon borrowing capacity and market demand, which is then reflected in house price performance over that time. Today, we have a very different starting point, though. We're already in a generally higher interest rate environment, and households have already been dealing with severe cost of living constraints for some time now, which makes it more difficult to rapidly raise interest rates in the same way. Of course, the nature of the outcome here depends on the scale and the duration of the conflict in Iran, which does remain uncertain. But because of these differences in starting point for interest rates, the way that this plays out will have to be a little bit different to the way that it worked in 2022. And it's also important to remember how property generally behaves compared to other asset classes. As we've already seen, these overseas events, like this conflict in Iran, can have a secondary impact on property through interest rates. But property tends to be more shielded from these events than other assets are, because property is so locally driven. We know that highly liquid assets like shares react much more suddenly to global shocks, which is what you can see clearly in this chart with the major volatility in equity markets compared to property over time. Housing markets are slower moving and less volatile because of those local fundamentals. And those fundamentals do point to house price growth in the year ahead. So, should property investors be concerned? It's worth being aware of and considering the potential impact upon interest rates, but it shouldn't change your investment strategy on its own. Short-term pressures like overseas conflicts can have a temporary impact on borrowing conditions, but they don't change the structural reality of the housing market. A conflict on the other side of the world isn't going to build more homes here in Australia, and that chronic undersupply that underpins long-term property growth remains firmly in place. We'd love to hear your thoughts, though. Of course, are you concerned about a 2022 style impact on the market here, or do you think this will pass through without too much damage? Let us know in the comments, and we'll see you in the next video. Thank you.